Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everyone, to this week's FIN-LYT podcast. Today, I'm joined by Ben Ruttenberg and Jamison Smith. Really looking forward to this podcast. We have a lot of questions come in with private investments. A lot of high net worth clients get pitched all kinds of things at all times of day, it seems like. And so we're constantly doing due diligence on behalf of our clients to vet out these deals. And as such, we've had some really good perspective on what's worked and what's not worked. But and a lot of times it's with these private investments, it can be a guessing game. So speaking of guessing games, I wanted to pick your guys' brains. Who do you think this week is going to be the second round of the NFL playoffs? So who do you guys like? Jamison, we'll start with you. Who do you think is going to win the Super Bowl?
So this is definitely going to air maybe even after the Super Bowl. So I think in the AFC, I think the Chiefs are just they're coming alive. I think the AFC is wide open. They have playoff experience. So I like them to go to the Super Bowl. I think Baltimore is the best team, but I don't know that they haven't shown they can win the playoffs. Chiefs, and then 49ers have just been dominant. So I think that'll be the Super Bowl.
Who's going to take it? 49ers.
Go with the Chiefs. I think they're going to do it. I don't know. I'm a huge Patrick Mahomes fan, though, so I'm totally biased. But
yeah, if he stays healthy, they can beat anyone. Ben, how about you?
I've been all in on the Niners all season. I think they're the best team. I understand the Ravens beat them in the regular season, but I've got a lot of faith in Kyle Shanahan, in Christian McCaffrey, Deebo Samuel, Nick Bosa. There's just too much talent on that team, and I like the way it broke out for them in the NFC. Dallas and Philly are out. I think they have an easy path. So willing to be wrong. We'll see when this airs, but I got the Niners definitely coming out of the NFC and probably winning the Super Bowl.
Who you like in the AFC?
Probably Baltimore. I think their defense has been really good, especially in the second half of the regular season. I feel like they're getting healthy, I obviously it's hard to bet against Patrick Mahomes, like you said, but I think they've got a much tougher test with Buffalo in the divisional round. I think that's going to be a war, and I think Baltimore will take care of business against Houston. So I think it's going to be a great Super Bowl if it is Niners and Ravens.
You're going to go CJ Stroud.
I know CJ's my guy. He's had an amazing rookie year. Very happy for CJ, but I think they're playing a different animal in Baltimore.
Who do you like?
Well, I have so many things I want to say to Ben right now. I'm going to limit it to just a couple. So, the Harbaughs, they just win. Just like Michigan, won the whole thing. They beat Ohio State. I hate to say it. I think Harbaugh's the other Harbaugh, the better Harbaugh, because he already beat his brother in a Super Bowl, is going to take it this year with Lamar behind the wheels.
We were talking yesterday. Has Lamar Jackson won a playoff game ever?
He's 1-3, I think.
1-3.
Yeah.
1-3. I know they lost when they were a 1 seed to the Titans. Yeah. They were a big favorite and they lost.
Last year he didn't play.
Titans upset everyone in the playoffs, though.
Last year they did not play. I remember I think they lost to the Chargers one year. But it's he could use a couple wins, that's for sure.
All right. I guess this could be a sports podcast. How knowledgeable you guys are. Hopefully you're as knowledgeable as sports as your private investments. We'll see. So thanks for those predictions, guys. So Jamison, tell us first. So we have this broken down. I would say there's really, in general, there's three types of private investments. There's private equity investments, which is a lot of people think they're doing private equity and they're not. Private equity is basically these big mega firms, rich firms that have a lot of money that basically own everything, and most people don't know they own everything that's not public. Then there's the venture capital world, and then there's just kind of we'll call it the mom and pop private deals, where it's a friend or family members starting a company from scratch. So those would be the three categories. You guys have any other categories you'd add to that?
I would just categorize all these as alternatives. So anything that's not on a publicly traded market. I think that's a good description of the three main opportunities out there. I would say maybe real estate. There's a lot of real estate syndicates deals that fall under that category.
Yeah. Maybe four. So private equity, there's venture capital, there's the mom and pop, just private deals, and then there's the real estate stuff.
Yeah.
So,
and these would all be categorized as, like you said, alternative investments. So outside of your retirement assets or outside of your non-qualified brokerage assets. This is a totally separate category, and we'll get into why that's important in a second.
And I say before we dive into the specifics, I guess the big difference is like a publicly traded company on the stock market's regulated, SEC. There's a ton of regulation. A lot of times there could be regulation, but a lot of times there's much less regulation. So that's one of the main differences. Is it's literally totally private.
Yeah, absolutely. So, who wants to take private equity?
Sure. Yeah. Private equity, basically, like you said before, massive companies. It involves investing in private companies or companies not publicly traded on any sort of stock exchange. And some examples of like really large private equity firms would be like Apollo Global Management LLC. They have $150 billion valuation. Caesars Entertainment Group, they've invested in Norwegian Cruise Line. They've invested in. Their strategy is to buy mostly.
Real quick side note:
Yeah,
Norwegian Cruise Line. Someone signed me up for as a prank. Signed me up for like a thing. I blocked the number. I still get how the voicemails show up on your blocked list every day. I still get it from a year straight. I get a call try to sign up for Norwegian Cruise Lines. I'm guessing that's probably one of their most profitable investments
because they're funded by a company that has $150 billion valuation. Someone had their coffee that morning when they figured that out. But their private equity firm, their strategy is mostly to buy mature companies that are already established. And their goal is to streamline operations to ultimately increase revenues. So generally speaking, private equity firms will buy 100% ownership of the companies that they invest. Usually can be in any industry, which we'll get into the differences between VC and private equity in a second. But usually when you buy such an established company, there is an expected positive return because you're buying an established company and you're looking to just streamline operations and try to make things efficient moving forward.
And then flip it. I mean,
Exactly.
so basically private equity companies, generally speaking, they're looking for like 3 to 5 year exits where they're double, 3xing, maybe even 4xing, 10xing their investment, and they're flipping it. So private equity companies with billions, like you mentioned Apollo, $150 billion valuation right now, Blackstone, $146 billion in private assets. Like these companies aren't messing around. So they're not going to go to you and say, hey, we want 50K minimum investment, come in and we're going to it's just unavailable unless you have like, hey, here's 100 million, I'll throw into the deal. Like this is just going to be off limits. A lot of people think they're doing private equity. You're not. Private equity groups are like preserved for the elite, like super top 1% of the top 1%.
Yeah.
Or you're a partner in a private equity and typically you're putting your own money in to fund deals along with debt typically. And then if it goes well, you're making a lot of money. And so
yeah, just real quick on that, 25% of all private equity deals are between 25 million and 100 million. So we're talking about, like you said, super, super high net worth. People might be thinking they're doing private equity when they're doing other types of investing,
which we'll get into. But real quick on the private equity, I mean, there has been a movement again because like a lot of private equity, unfortunately, they'll make companies grow, and then the exit sometimes is the IPO, and then all the people that are in it big want their money out, so that it almost becomes like a pump and dump scheme where then it goes public. All the like middle class people say, "Oh, I want in on that's like super like Instacart. I want to buy the shares." Well, the easy money's already been made, and then all the rich people exit, take their 2x, 4x, 10x profits, and then the share prices crash. And that's why we did a podcast on this recently, but it's like over, I don't know, like 2/3 of IPOs in the last couple of years have been on like you've lost money. Mm-hmm. Historically, that hasn't been the case. But IPOs are basically a way to get wealth transfer from poor people to rich people at this point. So be really careful when an IPO occurs. It's probably not what you think it is. So James, anything to add on the private equity side before we pass the ball to you for venture capital?
No, I would say their main goal, like a private equity firm, it's pretty like cutthroat. Like they want all they care. That's a tough word. They care about profitability. They want to be profitable. They want to be like, that's what they're looking to do. They're looking to
extremely good at their jobs. Yes. I mean, we have some clients in private equity. They do very well.
Yeah.
And they've like, from what I understand, like from the clients that we work with, like I've never heard of them doing a bad deal.
Yeah.
So they're doing, not guaranteed deals, but deals that are highly in their favor that they're going to be able to flip for a huge profit in 4x. So private equities is like, get out of the way
Yeah.
kind of
They
deal.
know what they're doing. They've
Yes.
done it. It's, yeah.
These
And
are
with that-
these are Ivy League,
Yeah.
Harvard,
Yeah.
Harvard, Princeton, like the elite of those schools
Smartest people,
are
yeah.
going in to work at private
Smart
equity.
guys, really smart guys and girls that usually have a lot of third parties too, with a lot of due diligence. So this involves a lot of management consultants, a lot of lawyers, a lot of auditors. There's just a lot of parties in figuring out which deals to make and processing the deals as they come. We'll get into other types of investing that there may not be as much due diligence or as many kind of heads at the table trying to figure out how best to do this.
And one more thing I'm going to say is that private equity has stormed into the RIA space. And in my humble opinion, it's created a lot of conflicts of interest. A lot of advisors have exited big broker dealers because of all the conflicts of interest that existed. So I want to wear one hat for clients, and now assume that a private equity company comes in where their only goal is profits. Imagine now the pressure on that REA to produce profits if they accepted a lot of times I've seen, like, I've had some friends sell like 20% stake. So a lot of times private equity deals, like, they take over the whole company. Sometimes it's a minority stake, but I have seen, it can do really good from a growth perspective. It can also, produce conflicts of interest. So we've been approached several times but politely have declined. As the goal here is best service for clients, have a company that exists long term, and eliminate conflicts of interest. So that's been the route we've taken thus far. So had real life experience in that, which is pretty cool. But Jamison, venture capital, what is it? What are some examples, etc.?
So venture capital is, I guess, essentially like the opposite end of the spectrum. They're looking for small startups. This is really popular in the tech space. So like I'm like a huge nerd. I love like learning about this stuff. But like I think of like that show about Uber. What else? There's the show about Elizabeth Holmes. It's on Hulu. That's like talks about this stuff.
That show about Uber is pretty good. What's that called? It's on Netflix now.
Super Pump.
Is there another season going to come out?
I don't know.
Because it kind of left at a pretty big cliffhanger,
Yeah, that's that's a great show. And then what's the Bad Blood? Is that the
I don't know.
about the whole thing? It's great. But anyway, any like movie show about like a startup, there's just going to be some sort of like venture capital firm. Usually
That's real life though. Uber was a venture capital based.
Yeah. Like any
So that's a good
big
example.
tech company that's blown up in the last 20 years has been backed by a venture capital firm. Because basically what happens, you have a lot of these like if we went and started a tech company and our goal was to get like, $1 billion valuation, they may be like, hey, you guys are young. We need somebody that's like done this before, has experience, that's exited companies, and they'll bring them in, they'll fund it, and then kind of oversee everything. And it's kind of like I feel like it's like a meme you would see, but it's like almost like having like a parent on like a young like startup founder that's like
a
in their
chaperone
20s. Yeah,
following you
basically
around.
is like
Yeah.
what it is. Anyway, so similar to private equity, their main goal is to take startups with high potential and then get them to grow, IPO, exit, something like that. And a lot of times these are like, or at least from what I know about like venture capital funds and firms, they're more of like they're cool if like 1 in 20 hits, because that one that hits is going to be like 100x the return.
It makes up all the losses.
Yeah. So it's almost like gambling, whereas like private equity, it's more of like, hey, we know this is going to work, and it may not hit as big, but they want like, more wins, I guess.
That's why if you approach a private equity company and say, hey, I want to put 100,000 in, they're going to laugh at you.
Yeah.
But a venture capital company would say, sure.
Probably take it. Yeah. Yeah.
We're going to put it in these two deals that are far, long shots.
Yeah, like you said, James, the private equity, these are established companies that are looking to make profits. VC is, hey, there's a new AI tool, there's a new biotech tool, new clean technology tool, like new niches, new industries, new ideas. That's primarily what's funding these new VC deals, whereas private equity is the total opposite. It's super established, super high barriers of entry. Total opposite ends of the spectrum, like you said.
And so like popular common firms like Sequoia Capital is a big one. They backed Google, Apple, a lot of tech companies. And Andreessen Horowitz, I actually, that book, The Hard Thing About Hard Things we've talked about, that's Mark Andreessen, Ben Horowitz wrote that. Mark Andreessen wrote something else. But they were in, a lot of these guys, they'll start a tech company, they'll sell it and then they move over to venture capital. Like Peter Thiel has a venture capital firm, and that's really the goal.
He's the famous guy that put all that in a Roth.
In the Roth,
He has
the PayPal stock.
$5 billion in a Roth.
I think it's PayPal or something.
Is that right? $5 billion or something?
Yeah,
Something like
something
that.
crazy. Yeah.
Man.
Yeah.
And then he's basically who caused the Silicon Valley
Bank
to collapse through
Yeah.
Twitter.
Yeah.
Or an X tweet or whatever was that Twitter back then.
Yeah.
Interesting character.
Yeah. He's a really smart guy. But yeah, so that's basically it, Ben. I know you did a lot of research on this. Anything to add?
Yeah, I would say, well, like I said, the private equity is usually between 25 and 100 million. Like most of those deals fall in that range. VCs spend generally 10 million or less. Startups are usually very unpredictable. And then there's also very little due diligence required, if any, as like a VC investment can be made because someone believes in the firm founder's idea, and that's basically all the green light that they need to actually start giving money. There's not a lot of like auditor, lawyer, consultant work like a private equity deal would be. VC is like, hey, that sounds like a good idea. Like, yeah, sure, take it.
That's a good point. And I've read Peter Thiel's book. I've read, like I said, The Hard Thing About Hard Things. Like and I've heard a lot of these guys talk. They literally will say, like, we want a founder that just, like, we like who they are as a person. We think they're determined, and, like, whatever that person touches will be successful. Mm-hmm. So to your point, there is not a lot of, like,
due diligence.
There could be not a lot of, like, color, black and white facts. It's just like, hey, you seem like you have character traits of a successful person. We're going to, like, bet on you, which obviously could have huge upside or, could fail miserably.
Yeah, no question. Well, let's talk about the differences then. So you hit on some of those. The amounts. Ben, what are some other ways to distinguish between private equity and venture capital?
Yeah, outside of what we've already mentioned, I think a couple of the big differentiating points between private equity and VC. Number one, private equity generally use both equity and debt to invest, whereas most VC investments use just equity. There's usually not a lot of debt involved in any sort of venture capital. And just on both sides, like VC firms generally will invest small amounts into like a seed stage. Like if a company hasn't gotten off the ground yet, you'll see like smaller investments. Whereas if they're in more of an expansion phase, you'll see larger sums invested. So a big differentiating point is that when these investors actually do invest and they obtain equity, it just depends on how much voice they actually get in the company's decisions. So a lot of times like VC firms will want someone's funding, they'll want to gather funding, but they don't necessarily want them to have a say in the company's future or have a say in ideas. So that could be a differentiating point in private equity and VC, where VC you could have investors start getting equity and a voice in the company's decisions, whereas private equity is mostly just funding.
Perfect. Okay, let's go into the third category. So just like private investments. So private investment could be literally anything. Like I've seen it all from hey, we want 10 people to invest. We're going to buy car washes. And that's kind of like a real estate syndicate. We're going to give you an 8% guarantee and you're going to get 20% of the profits, or just something simple. So everything like this we've analyzed. We've seen
parking lots, shopping plazas, like literally anything.
Anything, yeah.
Malls.
We're going to go in and we're going to put in franchises. We're going to any amount of stuff. I want to focus real quick on the real estate stuff. I think this is really interesting. Every real estate investment I've seen typically guarantees like a high interest rate and then some kind of fee and then some kind of profit share on the back end. I did this chart because one that I was looking at was like a 16% simple interest. So it's like, okay, that's pretty high, right? But if you look at like the stock market historically, it compounds at 9, but the S&P 500 compounds at like over 10. Yeah, but that's like the last 100 years. But let's back a percentage off, 1.5% off, etc. So if you look at 5 years, like if you had $100,000 you put into an investment, 9% versus 16%. The 16% wins over 5 years by $23,000.
Simple interest? Is that what you're saying?
Simple interest. But then if you look at 30 years out, the simple interest, even though it's 16 versus a 9, it's $893,000 behind.
What's the initial investment?
$100,000. So $100,000 if it's compounded at 9% would grow to $1.47 million. $100,000 if you get simple interest for 30 years would grow to $580,000.
Can you explain the difference, just like in like you're talking to your golden retrievers, Sammy and Chloe, like what's the difference between simple and compound?
Yeah, so compounded, you're putting, like, let's say, the simple interest, you're getting 16, 16, 16 every year. That's not getting reinvested. So you're not getting 16 just on the 100. And then compound would be you're getting 9, but the 9's getting reinvested. So now you're getting 9 on 109. And then the next year you're getting 9 on 118, and it keeps compounding and compounding. And there's a hockey stick with compounding interest that just explodes like after 10, 20 years. So that's one thing, piece of advice. We'll go right into advice now, but a lot of times it's kind of like index. Sometimes like private investments can like look as good as index annuities, which we know are like the worst creation in financial planning ever, probably. Anything indexed, like index annuities, indexed life insurance, etc. It's like, oh, stock market returns with no downside risk. What the reality is, like, no, you're gonna end up getting like less than you would in a CD in a bank long term, and the policy expenses are gonna make you implode early. But anyway, so we actually did a podcast just on that, on the annuity, so we can reference that. But let's go through piece of advice. If clients are looking at private investments, how do we advise? How do we recommend the due diligence, et cetera? So let's just go around until we run out of a piece of advice. But James, what would your first piece of advice be?
I would say really do your homework and ask the right questions, because like you said, they look shiny and cool and great, but then when you like pop the hood open, there's a lot of hidden fees. There's a lot of like just a million things that aren't necessarily disclosed. So I would say ask the right questions and do your homework. Yeah.
So out of all, we generally recommend against private investments, but unfortunately they're really cool to talk about. And it's kind of like that sexy part of investing. So sometimes we'll be in meetings where we'll talk about now or just about like the private part of the balance sheet. So I actually did just a data set on our clients. Now, granted, we have about 400 households at this point. And so only 10% of them have done private investments, like a little bit less than 10%. So I'm just rounding up just to make sure we're not misquoting here. And out of the 10% that have done them, there's been under 300 deals that our clients have done in private. There's been several clients that have done the majority of those. But then in further looking at out of those deals, ones that are at least 3 years or more mature, like you made the investment and 3 years have gone by, less than 10% of those to date, now not saying they're not going to hit, have hit. And so a lot of those investments have a couple things in common. There was big promises up front, but in the reality what's happened is with interest rates going up, the companies are going back to the investors asking for more money because debt payments are coming due, and now instead of having a 3% interest rate, they have 7%. So as a small company, if have gotten funded privately and you're a high risk, like most likely a bank's not going to give you a good interest rate if you say, hey, we need a couple $1 million to survive until our company gets sold. It's just not going to happen. So a lot of these come with, capital calls, and you need to look at the agreement. Like if I invest $100K in 3 years, are you going to come back to me for another $100K? Or if I don't give you that capital call, are you going to dilute my shares drastically? So all questions, all things you have to look at contractually before you make the investment.
Yeah, I think about that like if you're doing like a trip to Vegas or you're doing a trip to the casino, popular strategy to make sure you don't run out of money is take out money before you go and then tell yourself, hey, I'm not taking out anything more. Like this is what, if I go down this, I'm done. That's that. Very responsible way to,
Is that what you do?
to have fun. Yeah, of course.
Did you do that, Matt?
No, why are you laughing at me? I just don't carry a debit card around me. So then I'm not tempted. So
think about that in relation to the private equity deal though. Like say, hey, I'm putting an X in this period. That's it. If they call me for more, like, am I going to put in more? If they call me in a year and they're struggling and they need X to fix this problem that I didn't know existed a year ago, am I going to put in more? Am I not going to put in more?
Yeah.
Having those boundaries in place before you make the investment is so important because we've seen this kind of spiral where it starts out as an X investment, it turns into a Y investment, it turns into a Z investment. And we're going to have some kind of guardrails in place for how much of our net worth we want to stay in private equity. And that's the quickest way that this can get kind of out of control.
Yes. Go ahead, James.
I was say, what guardrails do we recommend?
Yeah, so first of all, make sure financial planning's on track. period. No correlation, no need to have a big private investment hit or not hit. Assuming it's on track and you have excess funds, make sure it's no more than 10% of your balance sheet at any point. So if your balance sheet's 20 million, you should have no, and your plan's on track with 10, even though you think, oh, that extra 10 I can just play with, never more than 10% of the total. So no more than 2 million in that example should be in these kind of private investments. Because what can happen is if you put all 10 and then this 10, you kind of become a, how else to put this, like that 10 kind of masters you, or now it requires your time, it requires your attention, all these board updates, and then, oh, we need capital calls. Well, now you're pulling from your good 10, that's a financial planning 10 to support the risky 10. So 10% or less of the total balance sheet, and that's assuming the financial plan's already on track. And then extreme due diligence. I mean, in reality, you should only be doing like 1 out of 20 deals that come across your plate, because there's a lot of bad deals. Every pitch is going to be amazing. But in the reality, like the likelihood of like someone coming to you with like this bright idea and then be able to execute it start to finish. I mean, I think statistically it's like what, less than 5% of
businesses
of like startup from scratch businesses actually make it.
Yeah, like most fail.
Yeah, like most financial advisors that can go to like a big broker dealer, 3% of them make it, and that's kind of like a startup
Same
business,
thing,
and they have a playbook to follow.
Yeah.
If you follow this playbook, you're guaranteed successful.
Yeah.
It's still only 3%.
The only ones that succeed are the ones that are sane enough that think they can beat the insane enough, I guess, or however you want to look at it. Yeah.
I guess the venture capital people have it right. They pick the right people. That,
Yeah.
I don't know. And that's totally different than private equity, because private equity is like going after companies that have already shown big success that could just improve stuff. But again, that's why private equity is not available to individual investors. Even if you're a accredited investor, typically you're not going to have enough money to get involved with like a private equity firm. So, okay, what else? What other piece of advice do we have?
Yeah, I would say I hate bringing this back to sports, but I was just watching a 30 for 30 recently called Broke. It's a documentary.
It's a good one.
It's a really good one. It's about how athletes go broke. There's a lot of good lessons around taxes, and it circles back to private equity here, because a lot of athletes are almost preyed upon in terms of, hey, it's very public, their net worth, like people know that they have money, their contracts are easily Googled and readily available to see. And so they get pitched all the time, and oftentimes they have family members or best friends that say, hey, like, I got this great idea, like all I need is your money, and they know that you have it. So learning how to say no, and especially when it comes to friends and family in regards to these deals, like that's so important. For all the reasons we said, not all of these will be successful. And then in regards to how to keep your total net worth under, keep your net worth and your private equity deals, like make sure that that's in balance. Learning how to say no, even if it's a friend and family, understand that, your financial plan needs to come first in regards to this.
Unfortunately, I'm going to say a couple things with that. Psychology and our brains we're completely opposite to all this, because like humans by nature, we're in the most nonviolent world we've ever lived in. We have less poverty than in history. Technology advancements, we have more people going into middle class from poverty, and so there's all these good factors, and still people aren't as happy as they were. So we're sending this book out from Morgan Housel, same as ever. One of the big points he make is like one of the happiest points was like after a period of like the Great Depression, then it was kind of boomed. It's like everyone was happy because of that perspective. Well, now we don't have this perspective. We just want more and more and more and more. And so humans by nature are just so competitive that if they can think I can get an upper hand on my friends and family and if this investment could change my life if it 10x's, that's like literally a Wolf of Wall Street. Like people were buying penny stocks, which were like the worst than any investment you could ever make, because of the pitches being so great. Like you could pay off your mortgage. So just realize, like, you have to know yourself. It's so hard to stay disciplined and keep that perspective in place, but it's so easy to say, yeah, I want to do this. This could change my life if it happens, when more likely it could really hurt you if you put too much in. And then the second thing I'm going to say, is a lot of these private equities, Morgan Housel in that book, he talks about, and some recent podcast interviews, he talks about this concept of like social debt. So back to athletes, he says athletes don't go broke because they spend too much. They go broke because of like their fifth cousin buying them a house. Oh, yeah. And so like they grow up in poverty, and then they buy their mom a house and their cousin, and then it's like their fifth cousin or whoever is like, I need to buy him like a decent house. They just can't afford to do all that. And I've seen that play out in private equity deals. not private equities, private deals, where it's kind of like, okay, here's my friend, he's a founder, I'm going to fund him, and then suddenly it's next year, he needs a little bit more next year, and so you kind of feel your friend knows how successful you are, how much income, generally you make, you're good standing, and now suddenly like, you feel the pressure to like fund that debt when it's not on you. But it's very similar to like what athletes go through with like their family and friends, these private investments. If you're dealing with friends and family, it can kind of turn into that social debt aspect a little bit. And we've seen that unfortunately happen in real life, not to a devastating point, but it's like to a point of like, wow, if we didn't have these investments, we could have like double the net worth right now. So, okay, well, let's assume that you've made a private equity investment and it's gone. We think it's going really good. Like, okay, in a year or two, this may be one of the 10 that actually hits it big. So from a financial planning standpoint now, what are some things that we could do? What are some tactics we could do to plan efficiently for taxes or whatnot?
This will be harder to do, but like you said at the very beginning, we've seen these owned inside of a Roth IRA. So you could, buy it with like an IRA and then convert it to Roth, or buy it inside of the Roth IRA. So if you have the ability to do that, you could avoid a lot of taxes. That's one.
Yeah, so if you have like 100,000 you put into investment, we have a couple clients have done this. You set up a self-directed IRA. That way, if it's a 10x or if the 100,000 turns into $1 million on the back end, that's all tax-free. It's all in the Roth, and you get to kind of invest it regularly after it hits. Versus if you put 100 in just with cash, grows to $1 million, then you're paying capital. 23.8% if you're a high income earner. Of that 900 is going to go right to taxes. So that's just like low hanging fruit. If it's a high conviction. If it's a risky investment, if you put in a Roth IRA, you're wasting precious Roth money on something that could go to zero. So that's a really you could look like a genius if it's done right, or you could be like, oh, that hurt if it goes bad.
Yeah,
that's a good one. What else?
I would say a trust, an irrevocable trust. So use that $100,000 investment again. I'm not going to get into the details of. Let's just say you're able to get that into a trust through gifting, and you do. That $100,000 now is out of your estate. If you're over the estate exemption and you use up your estate credit, that's taxed at 40%. However, if that $100,000 is now out of the estate and it hits to $1 million, now that $1 million's entirely out of the estate, while you just used the gifting exemption of the $100,000 and could avoid that 40% tax. So irrevocable trust would be another way.
And that's typically one that comes with like no repercussions. Like if you have, like, let's say you're a married couple and you have 3 kids, like, so one spouse, it's $18,000 per kid that you don't even need to report. So 3 times 18 would be what? 54,000.
Yeah.
And then you have a spouse that can do 50, so that's times 2, that's 108. So you could put that 100,000 in without using any of your lifetime gift exemption if it was a joint investment that you and your spouse made. And that way, if it hits, awesome. Like if that 100,000 grows to $1 million, that's out of your estate. If it's in a spousal life access trust, technically you can still use the money through your spouse as the trustee, etc. But then also, if it doesn't hit, and you weren't using that exemption anyways, no harm, no foul. I mean,
probably already have the trust in place anyway. So it's
yeah. So that's one we love, because if it does hit, awesome. If it doesn't hit, we didn't get hurt at all. If it was a small enough investment to not utilize gifting exemption. Even if it was a big enough investment to utilize gifting exemption, we're still, like, this is like a 80% probability it's going to hit in 2 years. That's still a great time to move it in there at a low valuation, let it pop inside the trust, and then all that appreciation is now out of your estate forever for kids, if that's your goal.
And that's probably the best way, but we've also seen people just put it in kids' names directly. Similar type thing. Then if it hits, the kid has the money.
Trust, especially if your kid is over 18 and responsible.
Trust probably makes some extra protection mechanisms, but
for sure,
one way or the other will get the same outcome.
Okay, awesome. Well, any closing thoughts on private investments? Ben, throw the ball to you first.
Yeah, I would just say, just to recap everything we talked about, know what you're getting yourself into. Understand the difference between, is this a VC investment? Is this just like my friend has an idea? Like, how much am I going to be putting in up front? Is there going to be any more additional calls? And then be aware, like, do I actually believe in this idea, or is this a family or friend that's soliciting me?
Absolutely. Jamison, what about you?
Yeah, I'd say do your homework and then make investment decisions. We talk about on 3 things. Number 1, what's the rate of return? Obviously, the rate of return here could be good. Number 2, what's your time commitment, how much of your time is it going to take? And number 3 is stress or peace of mind. So, usually use those 3 things as a decision-making framework for investments.
Yeah, and my advice would be all what you guys said. I would ask yourself a lot of questions. Is it passive or active? Oh, it's passive. Is it really passive? Go deeper. Well, from our experience, like the passive investments turn into, now the founder wants you on like a board meeting update call every quarter. Now they're soliciting you for more money. Now they're soliciting you if you know any friends that want money. And now it's kind of like you're orchestrating almost not a full-time job. And that's not passive. Passive means you put it in and 3 years from now you say, hey, good news. Here's 3x your money back. That's passive. Passive is not constant communication and updates and letters and asks. That's not passive at all. So you have to ask yourself, is this passive or active? Typically, if you have the money to invest in a private equity firm, you probably don't have the time to be active in your private investments. You're making your money on your day job or your business or whatever it is. So protect your time at all costs. That's number 1. Then number 2, again, we talked about is the capital calls. This is a one-time contribution. It might be expected to bankroll this company until it fails or succeeds. And number 3 is just ask yourself, why am I making this investment? And go 7 layers deep. I think it's a good investment. Well, why is that? Why? And typically you'll arrive to, okay, this is a no-brainer, or you arrive at like, this is just stupid gambling. I want to feel good. I want to talk about it. You know what? I can achieve this by just diversified investing and be just as, I may miss that happiness or that dopamine hit of like talking about cool stuff with my friends, but I'm going to protect my time and my peace of mind and my financial resources I've worked so hard to create. So those are my closing thoughts. But as always, thanks everyone for joining and look forward to catching you next week. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast and please share with any friends or family members that would also find this beneficial. Thank you very much.